All right, so finally, after getting a good move yesterday that was above average and a solid direction, a little bit of in this case a breakaway gap like we talked about in last night's video, a lot of good bullish signals that were produced in yesterday's move, and then we followed up today with back to being nothing, right? Very below average volumes, below average ranges, volatility back to being really low. Again, all the red flags we talk about that have the potential of limiting this particular run. That now I think it's not gonna fail on us and push us down the lower lows, but it may be limited to where we don't go up very much further from here. And again, I'm gonna break all that down in today's video. Same things that are driving risk aversion in general are still there. Big important levels in the dollar and commodities and bond yields. We're going to break that down. Important sector rotation that's not exactly the most bullish. We're not getting a surge in besides volume and breadth either. So we're still kind of missing some things that you typically get when you're 6% or almost 7% into a 15% rally. That's going to end up being 3 months long and nice strong move to the upside. We're missing a lot of those things, and I'll show you today and the implications that they may have on this current bullish run that we are on, that we are definitely on right now. So, but that doesn't mean, again, we can't make bullish trades, and today's trade idea will kind of follow the same pattern we've been doing in the last few market outlook videos with more bullish trades up to the upside. So let's go ahead and get started. Today is Thursday, May the 16th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these other things over here on the right, including our Market Outlook live video. This is where I review old Market Outlook trades, see whether we should stay in them, get out of them. We closed out one today. Obviously put on today's trade idea already before the market closed. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click on this thumbs up icon. It opens up this tab and hit that like button. Again, the more you do that, it helps get our content out to all of our followers on those platforms. So thank you to those who do this day in and day out. It's a big deal to us. We really appreciate that. Those who don't, you can do right now while you're watching with one or two really easy clicks. We can get up to 100 on our 100 like goal that we have for our Market Outlook tweet. All right, let's take a look at the S&P 500 with the market forecast indicator first. And we see, again, very small range. So we're back. After one day of a slightly above average range, we're right back to very, very low averages, well below the range. In fact, the ATR is almost back in the 40s again that quickly. So, it's been moving pretty rapidly here. That's what happens when you're barely above the midpoint of the ATR for the full day. Coming after a cluster, remember we got an overbought cluster yesterday. Not surprising, the momentum line drops. That's what happens when you get smaller ranges. You get a drop in the momentum line. But we didn't drop very much, so the near-term line actually stayed pretty bullish. You can see the near-term line stayed bullish this entire rally when we had all these really small ranges as well. Some up, some down. But the near-term line stayed in bullish territory. A little bit lower, but stayed in bullish territory. And we're still in bullish territory. We're still in the upper reversal zone now. So still holding a pretty good trend on the from a short-term sentiment. Again, despite the fact that you got a small bearish momentum line that, again, is not due to a drop, even though we did drop 0.2% today. It's mostly due to the fact that it's a small range. We are still above that 2.5% mark, above the moving average, which again kind of leads us in trending territory. We have dark green shading and a green line still. So everything is still on the up and up from the S&P standpoint. Looking at the Dow Jones, well, let's look at the NASDAQ first, since those two are the ones that are most like each other. Again, very similar pattern, momentum line dropping, near-term line dropping. The intermediate line is now above the 90th percentile. So very, very strong positioning here. Now let's take a look at the Dow Jones Industrial Average. And it looks pretty similar. Again, we got that cluster yesterday. Intermediate lines above the 90th percentile again. And then your near-term line setting up for potential near-term divergence. So something to kind of keep an eye on, as it had dropped more than the S&P. It actually dropped out of the reversal zone here, and then now on the bounce back up, we're at lower lows. We are below. It did cross below the intermediate line, while the intermediate line was still below 80, the 80th percentile. So that's, and we're still below it now. So there's a little sign of weakness there on the Dow Jones Industrial Average, but again, very minor. That cluster really helps solidify this bullish trend. And we hit 40,000 here today, even though we didn't finish above it. We hit up to 40,000, looks like 51 at the highs of the day today. So I still think we're in pretty decent shape there. Your Russell 2000, you can see, was down a little bit more. So as a result, again, a little bit more, a whopping 0.6%. So keep that. It's still not very much. It just happens to be more than what we saw in the large cap indexes. As a result, it brought the momentum line all the way down to extreme lows. So that's a little interesting to see. And your near-term line has also crossed below the intermediate line, though kind of on the cusp of the 80th percentile. So it's out of the reversal zone now. So a little bit worse, more bearish short-term sentiment on the Russell 2000. You can see market sentiment still falling on all these indexes. So the long-term trend is still kind of weakening because we had this intermediate pullback. It brought the market sentiment line down. But the longer longer the green line stays above the orange line, then we're okay, right? And again, as long as the intermediate line's in the reversal zone, and then the near-term line doesn't dip too far into bearish territory, you can see it produces these bullish lows, then we're okay. Once we start getting the bearish lows, you can see that's when you're starting to be closer to the end. Here was one instance there at the beginning of the year where we were also pretty close to potentially ending the intermediate run before we got that breakout right here on the 8th that led us up on the new leg higher. All right, let's take a look now at the weekly chart. You can see, again, remember this, we still only got 1 day left now, but it's easily a higher close, Hakunashi close. We are closing above last week's high point, so all very, very good there. Again, we're going to have a pretty good candle next week too. The PPO is still above its moving average. Excuse me, the Hakunashi differential still above its moving average. The PPO is still rising. So everything's good. The Russell 2000, remember, is a little bit weak on the short term, but still looks pretty darn good on the long term. Hakunashi close is higher. The high is higher. Everything is looking pretty decent. So really no issues in terms of like an imminent pullback. That today's drop is not going to lead into more bearishness. Your MACD is slowly moving lower, but your stochastics is still very strongly overbought, well above the moving averages. So we're nowhere near really even one red arrow, much less three on this. Remember, one red arrow is when you start to converge, right, where you get where the shading comes off. If I were to zoom out so you can see what it looks like on bullish trends, let's go out 2 years. You can see when you get one red arrow, the shading comes off, but you're still kind of bullish. It's not until you get the 3 red arrows that you start to see signs of weakness. You see that over here, and you can kind of see you get through, unless you bounce right off of them, like the same bear tag phenomenon that we've talked about before. Bull tag actually would be in this particular case. But your MACD and stochastics are so high, again, we're nowhere we're well above the moving average. We're not going to get a red arrow anytime soon to where we even turn white in the background without any shading, much less get the 3rd red arrow where we get a yellow line, and we're basically usually the last red arrow on the 3 red arrows, as you can see right here, is the moving average. That's usually what ends up being the last one. You can see it was over here as well by a day or two. So we're good. We're good in that regard as well. Looking at the DMI, we're still above 30. In fact, we're above 35. We're still below 20. The ADX is still rising. It's about to cross up above 20. So that's a good sign that we're really trending. The RSI and CCI are still at bullish levels. So that's a good sign. You can see the weekly CCI is back up above 100. So very, very good from that perspective, and well above 60 on the weekly RSI. Looking at the Ichimoku cloud, we have again that intermediate trend strength still going, positive rate of change. above the cloud, green lines above the blue line, all very good, right? No sign of weakness at all on that chart yet, at least. We are above, we're in the upper quartile, still not pushing up against the upper band, but at least we're in the upper quartile. We have a rising bandwidth. We're still above the upper Keltner channel after yesterday's breakout, which means that we still have strong momentum to the upside here. So very, very good, strong momentum, rising bandwidth. Again, very good signs. Nothing that screams any imminent weakness at all. We had a higher high and a higher low. We did not close above yesterday's high, so it's a little sign of weakness there, but no big. Again, very small range. You can see here that we did get a new high point today, so we still have 100 on the green line, and we're down to 0 now, so the low is way over here. The low is going to still be at 0 tomorrow. It'll jump up for a couple of days to there, and then we'll jump up again after that one over to here, actually to this low, and then we start to really move up higher. So for the next couple of weeks, it should be kind of around this area. Again, barring a new 4-week low point, which is unlikely, it should stay kind of in this area like we've seen before, with no major jumps to the upside. The actual channel width is well above the 5% mark, which is like right here in this area. So well above the 5%. So nice, good expansion of the price channel width with this bullish move. If you look at this chart, let's see, when we look at that chart on this basis, you can see we are still above the 90th percentile in terms of where we are in that 4-week range. And the moving average of this 20-day moving average is also into bullish territory now. So, again, we are really solidified on this bullish trend. The question, of course, is how big the trend will be. And of course, I think it'll be kind of more in this high single digits, maybe 10, maybe slightly 11, but mostly high single digits. And again, we're just under 7, so we only got, that we could potentially only have a few more percentage points left to go to the upside before we get another, I'm expecting another 5% or more decline coming after the green box hits that 8 to 10% range. Again, maybe up to 11, but more in that 8 to 10% range in that green box there. If you look at the volatility, let's see here. Oh no, the today's trading range. Let me show you that one. So let's look at the 3 green arrow chart. Zoom this out, you can see today's range was 3 points, so well below 5. The volume was at 50 million. So again, putting those numbers in context here, 50 million is well below the average, which is already extremely low. 5 points is right about 3 points, sorry, 2.98 is well off the chart for the ATR, so way below that average. So it's bringing the ATR down. That's bringing the ATR relative to the price level down as well. So we're back below 1% pretty easily there. When you look at that volume on a normalized basis, again, it's pretty low. We still haven't achieved or got close to the high point in money flow, even though we're well past the high point in price. So that again kind of goes to show that we're just lacking in substance, so to speak. You remember from a Brett standpoint, we still haven't gotten into this 80, 90. Remember, we got to minus 100, so we should be up into the 80, 90s. When you really start these bullish moves, that's when you get these big thrusts. And then you come down. We never really did. The highest we got to here was 65. And that's a pretty low level for, the peak of the breadth. I mean, we are back above 500. Very good sign. We're trending. But we're lacking in what we need in order to make this kind of a run, or this kind of a run, or really, a really good solid leg higher to the upside, where if and when we get a pullback, we only pull back, and in this case, barely 23% retracement on that one. But if you get the smaller rallies, like again, the 8 to 10% range, now your pullbacks end up being more than 38%, like even more than 50 more often than not. This is why it's really important that you get the good strong runs, say 11+%, so that when you get that 5% pullback, it's not that big of a drop on a percentage basis, on a retracement basis. All right, now let's take a look at the other red flag that we've noted before, and that's the volatility. Remains very low, below 12.5. The difference now versus recently, when we were at 12.5 before, is the VIX 3M is really low. So the VIX 3M is down to some of its lower levels. That's why you can see it's down to its lowest level that we've had. The VVIX still remains below 80. The correlation between the VVIX and the VIX is almost negative. It probably will drop negative tomorrow unless we get a big jump up. And again, usually when you get a negative correlation on the VIX and the VVIX, that typically precedes a jump in volatility, both those instances. And of course, this one started a new trend higher in volatility. Considering how low the VIX and especially the VIX 3M is, a jump in volatility may be a little bit more uncomfortable than what we've seen previously when we weren't so extremely low in some of these volatility measures. All right, now let's talk about what's moving markets here today. So let's go out to, let's adjust today alone on this. And we'll come over here to May 16th, which is my anniversary. Today we are celebrating our 26th anniversary, my wife and I. Here is our, here's today's move. Again, small caps really kind of getting beat up. But again, this looks bad, but it's only 2/3%. So it's not that big of a deal. Developed markets down 0.5%. Gold is down a little bit. You have the strength in the dollar. You have strength in commodities. You have strength in yields. That's a bad combination for risk appetite. But again, didn't really impact risk appetite too much today. But we talked about here yesterday that some of these assets classes are sitting on important support levels, like the 200-day moving average for the dollar index. How likely is it to break that 200-day moving average? If you look at the 10-year yield, you can see that it's also on its 200-day moving average and rebounded a little bit. So how likely is it to break that level? You look at commodity prices. It's sitting on its 50-day and converging in between the rising 50 and the falling 200. So looking like it's pointed in the upward direction as well, holding support. So again, that's the three-headed monster. That when those three things rise together, that generally puts pressure. And the other factor that we've seen here recently is gold. And usually when gold makes a strong run in a very short period of time, in this case 26 days, but let's zoom out to like a 3-month return for gold. And this is, remember, the ETF that tracks gold. But we were close to a 20% run there in gold. So if I were to zoom this out a little bit for some context, the last time we had this was at right before the banking crisis, right there in the early part of 2023. Also, during the midst of the correction, we had a pretty decent 3-month run in gold. And then here in the middle of 2021, we had a pretty strong, but not nearly as strong here at the end of 2020, going into that, the intermediate pullback that we had in September and October, right before the election. We had a strong run there. And of course, in 2019, before we had our first rate cut of that mid-cycle adjustment there in 2019, that also had a strong run in gold. So you can see very similar, right? But you can also see too that generally after these strong runs, gold stops really going up very much, especially with such momentum that it's had. So here we are with a strong run up to 2020, and again on an absolute basis, it's at a pretty decently high level. If I were to take a look at gold here on this chart, again, let's go up to gold there. So if you look at it on an absolute basis, like on its own, like relative to US dollars, because that's what GLD is priced in, all-time highs. Like that's kind of where we're at, or near recent all-time highs. But if you look at it relative to an alternative like stocks, you can see it's not too extremely overbought. In fact, if I were to zoom back in here, it's still pretty down, relatively speaking. We are above the 200-day moving average. Just for some context, let me zoom out just a little bit the last 3 years. When gold does tend to outpace the stocks, we're generally in a bearish mode, like we were here, 2022, going into the banking crisis of 2023, and then the financial conditions loosened considerably, and gold ended up dropping relative to equities. And gold dropped big time relative to equities in 2021. during that bullish period in market. So here we are back down, relatively bullish, but back toward its 50-day moving average. And how likely are we to, we just broke the 200-day. Are we going to do what we did last summer, where last summer during the pullback in equities, this rebounded, but then it fell dramatically? Or are we going to make a run up like we did here at the beginning of 2022, a little bit of a pullback to like the 30-day average and then bounced up, right? That's the issue. When you look at gold relative to long-term bonds, which is another piece of paper, it's actually very overbought, right? So, there's an opportunity here. During 2022, it did outpace bonds as well, but then it's continued to outpace bonds. It's been, you can see, correlated with stocks in the wrong direction, generally speaking. But if I were to zoom out, you can kind of see what that correlation is like. Again, relative to the S&P as a proxy for risk appetite here in general, you can see that this correlation is generally positive. Some brief periods of negative during like QE there and a period of time here during the correction, but for the most part, it's got a positive correlation. So generally, gold underperforms until the very, very end of a bear market, like 2008, 2009, when we're actually in a bear market there. But during the correction phase, it's positive. So again, very parabolic here. In fact, you could argue, there's your CCI, there's your DMI up above 50. So you would expect that bonds will start to outpace gold, and that has generally not, again, if it's a positive correlation with risk appetite, then that would be another sign of weakness forthcoming for risk appetite. And remember the other ratios we kind of keep our eyes on. We talked about technology relative to the markets, and that's still holding its breakout that we had yesterday. Let's go to the daily chart. So there's yesterday's breakout, still well up above that. And what we need to see now is utilities breaking back down and below its 200-day, and that hasn't happened yet. And the other ratio that we've been kind of closely watching is discretionary relative to staples. That is breaking down. It's actually closing lower than what we saw here. So again, not a good sign for risk appetite to see discretionary really underperforming. And then finally, when you look at the interest rate sensitive areas like financials relative to utilities, also generally positively correlated to the markets, it has also broken down below its 200-day moving average. So utilities are outperforming not just financials, technology, but also financials in a different area of the market. So it kind of gives you a sense of both these interest rate sensitive, but in opposite directions, right? Utilities are, when rates go up, utilities underperform, financials outperform, and vice versa. So again, you can see that there are still some inklings of weakness where it doesn't look like we're starting a new 27% move higher to the upside like we had here when this was trending so bullish and the market went up 27% without even a 2% decline, much less a 5% decline. Over the last few months, it's been really weak, and despite the market bouncing up nearly 7%, this ratio is still below its 200-day moving average. And like XLY versus XLP is getting worse. All right. Now, speaking of that, let's take a look at how the sectors are doing. You can see technology is continuing into leading area, discretionary is continuing into the lagging area, right? And communication services, which was improving, is now just not moving, right? It's just stuck. It can't get going like technology did. So it's still stuck there. Utilities has still got very strong relative strength. Real estate is actually kind of following technology. Staples was weakening, still is weakening, but it was moving towards the lagging, and it kind of stopped its momentum in that direction. And you wonder if it's going to be able to start to move in the positive direction. You can see 5 days, over the last 5 days, energy is picking up some momentum, which is not necessarily the greatest thing because that's a lagging sector that typically does well at the very end of a bullish move at the beginning of the pullback move. So we'll kind of keep our eyes on that. And you can see discretionary's move has really been bearish there. And staples and utilities, this hasn't moved at all, but still maintaining strong relative strength. Communication services had some momentum to the upside, but not gaining any relative strength, just gaining some momentum here. So we'll see how that continues. But again, not the greatest rotation here that we want to see for there to be a strong move into risk appetite. Now, usually by the time we're up 6% off of a low point, XOK, XOY, and XOC are really leading, doing pretty well. And that's not the case right now. Here's what this chart, if I were to pull up the sector rotation, and let's go back again all the way to, let's just go to today really quick. And you can see Staples really been the big winner today. Everything else down just a little bit. But if I were to zoom out to, again, that Friday after expiration in April, where we got those oversold clusters on the S&P, we've been rebounding ever since. Again, technology and utilities are kind of moving hand in hand. Real estate's up there too. Those are the only three sectors outperforming the S&P. Everything else is lagging, with healthcare and staples outpacing everything else in the cyclical area, and energy really struggling, which is not surprising, but you can see it's not struggling. It's been basing. And that all you can see kind of a rolling over on some of these other lines up here at the right. So this is kind of something to keep an eye on as to how likely this intermediate trend that we have will get up to maybe just 8 or 9 or maybe 10, maybe a smidgen over 10, like 11, 11.05 or 11 and a half. That's kind of the idea there. Again, the more likely we are to be in that range, the more likely we are to get again deeper than a 38% retracement on the next 5% decline. Again, because simply 5% decline of a 9% rally is going to be more than 38%, well more, and going to be more than 50%, which is why it starts to get uncomfortable for people that are kind of going long on positions, like right now, on major positions right now, because of all the bullish signals we've been getting in this past week. All right, doesn't mean that we can't do bullish trades though, and we have been doing bullish trades, and we're going to do another one today. So we take a look at Marvell Technologies. Let's take a look actually at the market forecast chart for Marvell right there. And you can see a nice little breakout move here. You got a bear tag a couple of days ago. We followed through today with a nice breakout move up to the upside, a little off of the highs. Up 4% though, dark green shading and a green line as we are above 50 on the intermediate line, moving towards bullish levels. The near-term line following the momentum line up to bullish levels, up 7% above the moving average. Very good mark from that perspective. Looking at the weekly chart for Marvell, you can see we've had a few transition candles. That's a bearish move, but now we're pretty bullish. The Heikin-Ashi close is above these highs from the past few weeks. PPO is already relatively high, turning up. If I were to take a look at the RSI and the CCI, or some of these other, well, let's look at the 3 green arrow chart first. How about we do that? So let's come over here to this one first. Obviously, you're going to have 3 green arrows. You can see we got, yesterday we had 3 green arrows. Now we have the green line to go along with it, and more than 1.5 times the average volume. So that's a good indication there. And also, if you take a look at when we break those lines apart, you can see we're above the point of control. We broke above all these moving averages that are pretty much sitting on top of each other. MACD and stochastics at pretty decently bullish levels. Look at some of these other oscillators. Good DMI pattern above 35 on the positive indicator. Not below 20 yet, but your ADX is really low, so you're set up for a pretty good move, a breakout type move from a squeeze type pattern. Looking at the RSI and CCI, they're obviously also at bullish levels, well above. We're above 60 on the RSI, well above 100 on the CCI, up to above 200. So that's a good move there. Looking at the Ichimoku cloud and the trend strength indicators, you'll see that we don't even have a weak bullish trend developed yet. We're still slightly below the cloud, but we're definitely moving in the right direction. Rate of change is positive. The red line's crossed up above that close from 26 days ago. So we have a positive rate of change now. And the green line is crossed through the blue line with the price above both of them. So that's good. And then finally looking at the Bollinger Bands and the Keltner channels, you can see we are up. We were a lot closer to the upper band. We ended up, like I said, finishing off the highs. We also were above the Keltner channel above the highs when we put the trade on. Pulled back a little bit there. This is our stop order. What we ultimately did was a long call trade, at the money long call trade. Let's see, out to July. There it is. We bought at the money. This was at the money at the time. We bought at the money. It had the most extrinsic value. Now the 72.5 is at the money. Set your stop order at 50% of that value, and you can see, where the stop order ends up being, right? So if I were to look at like an intraday chart here for Marvell, we would have to drop, down past this breakout, back down towards the point of control in the midpoint of the chart for us to be stopped out. So we have some room to work with there before we'll take, in this case, looks like about a $600 loss on the trade. Let me zoom, get this to just looking at Marvell. There we go. So, again, 50% stop order put us at about $600 risk. And then, of course, if it does move your one standard deviation by July expiration for that $600 of risk, we're looking at about a $2,600 reward, which we'll definitely take, right, if it makes that kind of move. All right, well, that does it for today. You've heard from me now, and I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember, subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Thursday night, everybody, and we'll see you all next time.